Very few companies succeed without the use of loan facilities. A loan facility will help a company expand and grow faster than it would have without it. It helps a company buy more raw materials, buy more machines, increase labor, and therefore does more production, which means more sales and more profits. However, on the other hand, loans are the number one cause why most companies have problems with KRA, Kenya Revenue Authority. The main reason for that is because most business owners don't understand between the two different types of interest expense that are related with the loan facility. Number one, capital interest expense, and number two, operating interest expense. I will differentiate between the two. Number one, capital interest expense. This is the interest expense that you pay on the borrowed money when the project that you are funding with the borrowed money is still under construction. Think of a commercial building that will take 3 years to completion, and you have borrowed 100 million in year one. The amount borrowed will start accruing and attracting interest from the word go even before the project is completed. That interest expense that you will be paying when the project is still up and being constructed is what we refer as capital interest expense. On the other hand, once the project is completed and tenants have moved into the building and they are now paying rental income, at that point, the interest expense on the loan facility that you will still be paying is referred as operating interest expense. Now the question is, why does it matter so much for us to understand that? Is because the way you treat capital interest expense is different with the way you treat operating interest expense as far as KRA is concerned. Capital interest expense, you do not deduct it from the taxable profit of the company. You do not do that. You wait until the project is completed, and this interest expense will form part of the cost of the building. Remember, if you had borrowed 100 million and it took you and the loan is for 5 years, and you're using a flat rate to compute the interest payable, it means every year you are paying interest expense of 20 million, which is 20% of 100 million. So year 1, 20 million, year 2, year 3, year 4, year 5. That is 100 million on interest expense only. So the total cost of the building is the amount that you had borrowed 100 million plus another 100 million in form of the interest expense. So you can say the total cost of your building is not 100 million, but 200 million. And when you will be depreciating for the cost of the building, you will use the value of 200 million and not 100 million. So in short, the capital interest expense is recovered by a business through the wear and tear, through the capital allowance deductions, through the investment deductions, and not directly from the taxable profits in the year that these capital interest expense are incurred. On the other hand, when the business is up and running, remember the commercial building, it is now occupied by tenants, and you are still paying some loan facility. The loan facility repayments have two components, the principal part and the interest part. That interest part, you will treat it as fully deductible in the year of income when it is being paid, because it forms part of the cost that have been used wholly and exclusively for purposes of generating the income of that year. So the difference between capital interest expense And operating interest expense is when you deduct or when you recover that cost from the revenues that you are generating from your business. For capital interest expense, you only recover it through capital deductions. But for operating interest expense, once the business is up and running, you deduct it on a year-to-year basis. So, how do companies find themselves with trouble with KRA? Number one is when they treat capital interest expense as operating interest expense. The company has borrowed some amount of money, and that money has started to accrue and attract some interest expense. The company proceeds to deduct and treat that capital interest expense as a normal expense for the year, instead of capitalizing that expense, adding it to the total cost of the building so that it can be recovered through capital deductions. When KRA realizes that is what you have done, you are not patient to wait for the business to start operations. For this building generating income, when KRA realizes that, they disallow that capital interest expense that you had claimed as operating interest expense. They add it back to the taxable profits. And once they add it back, they recompute taxes again. And by the time they are doing this, they will slap you with more penalties, fines, and interest. So to avoid this, always ensure that you understand clearly the difference between capital interest expense and operating interest expense, because that knowledge, that awareness will help you avoid penalties, fines, and interest coming your way from KRA. And if this is not very clear, always ensure to consult a tax expert so that they can guide you on how to claim and what not to claim. Once you do that, your business will be protected, your profits will be protected, and most importantly, your peace of mind will be protected.